Good morning and welcome to Chaikin PowerFeed, your daily market digest. Today is a rainy Monday morning here in New York, September 10th, 2018. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. You can check me out on Twitter. I'm at DanRusso_CMT. PowerFeed TV brought to you today and every day by Chaikin Analytics in conjunction with StockCharts.com and StockCharts TV. You can sign up to receive Chaikin PowerFeed for free. Head over to ChaikinAnalytics.com/PowerFeed TV. So as we get into it on a Monday morning, U.S. equities were lower during the holiday shortened week last week, with the S&P 500 finishing down after rising in 8 of the 9 prior weeks. Treasuries were weaker with the curve steepening. The dollar was better overall, though slightly weaker on the yen cross. Gold was down again last week, finishing off about 0.5%, and oil recorded its worst week since mid-July, with WTI settling down nearly 3%, 2.9. S&P futures, as we get to the desk this morning, are up 40 basis points and near their best levels of the morning. Europe was mostly higher, but Asia was weak overnight. The dollar is down against the euro, but better on the yen. Gold is down 20 basis points and oil is higher, with WTI crude up 60 basis points, again, after 3 consecutive daily declines last week. And as we dive into the chart of the S&P 500, you can see we are testing support at the breakout level. Closed at 28.71 and change on Friday, although futures, as I said, are up this morning. So we'll call it a test of support at 28.73. Below that, 2800 and 27.36, your 200-day moving average, are your next key support levels. Resistance still comes into play at 2900 to 2920 in that zone. The RSI for the index remains in bullish ranges, and Chaikin money flow is bullish. So as we line everything up here, not a ton of change really at the index level, as well as at the sector level, right? Based on how we look at the world, power bars, utilities, healthcare, and tech still the leaders. Staples, materials, and energy still near the bottom of the list. So from a strategic standpoint, not a ton has changed as we come in here to start the new week. Your market in a minute. Stocks pulled back from all-time highs last week, mostly led by technology weakness, but really it was a lot of the growth and momentum names that came under pressure. We did see some rotation into the defensive parts of the market, and we'll take a look at that when we look at our sector snapshot in just a little bit. Small cap underperformance continues. Remember, about a month and a half, 2 months ago, we backed off of our call of aggressive small cap outperformance. The dollar has kind of gone sideways. We'll take a look at the dollar index. I think that's been a big cause. But, you know, money is rotated into the larger cap stocks within this market. And so from a relative basis, small caps are beginning to underperform, and that is ongoing. The 10-year yield advanced last week, as I said, but remains below that 3% level. I think sentiment and positioning have a lot to do with that. The U.S. dollar is holding support, and futures do, in fact, point to a higher open this morning. So if we check out the major indexes from a power bar perspective, the Dow is 8-3 in favor of the bulls. The S&P 500 saw some deterioration throughout the course of last week. We're now at 110 bullish or very bullish stocks, 73 bearish or very bearish stocks, still positive, but some deterioration. NASDAQ, same scenario playing out, 21 bulls, 14 bears, and small caps deteriorating as well. 412 bulls, 304 bears. Bonds downticked on Friday, sending the yield higher at 2.93, 2.94% for the 10-year yield. We hadn't seen those levels in a while. We'll take a look at that chart and try to figure out what it all means. According to the Chaikin Power Bar, small cap stocks and large cap stocks are somewhat bullish, and the major indexes are mixed. Our stock of the day, Chaikin Analytics PowerFeed subscribers will generate a stock idea for you every day. It's based off of our proprietary power gauge rating. And today's stock is Aaron's Inc. It's a very bullish power gauge rating for ticker symbol AAN, which closed at $50.61, up 18 basis points on Friday. Power gauge rating is very bullish due to very attractive financial metrics, very strong earnings performance, and positive expert activity. So let's kind of dive into the chart here and walk through our analysis. Ribbon at the bottom of the screen tells us where the power gauge has been over the past 12 months and where it is currently. We have a very bullish stock, strong trend, strong industry, and our dynamic duo here is in gear. Market is in agreement with our model as a very bullish stock is outperforming the market, and it's been outperforming for about a month or so. Stock is currently oversold based on our overbought, oversold indicator. We'd like to see a little bit more bullish money flow, especially with the stock trading near 52-week highs. But, from a price performance perspective, we are above the rising long-term trend line and above the breakout level here at around $49. So I think Aaron's is compelling. We have a very bullish stock and a strong trend and a strong industry. It's outperforming the market. It's become oversold. It has support just below in the $48, $49 range. Again, the stock went out at $50.61 yesterday. I think that AAN looks compelling here for a trade on the long side here and now. Take a look at ticker symbol AAN, Aaron's Inc. Checking out our sector tracker, moving to the major groups over the last 5 days. You can see the defensive posture with utilities and staples near the top of the list. Industrials also coming on. Industrials initially got hit hard when the trade war rhetoric first began, but they have subsequently rebounded. They actually have a power bar ratio that is positive and more bullish than the S&P 500. You can see it here, up 64 basis points over the last 5 days. We've seen some outperformance from financials of late as well. I mean, they've been flat over the past 5 days, but again, a similar scenario. A bullish power gauge rating that's stronger than the S&P 500. So, we can't ignore those two groups. At the bottom of the list, that comms group, the newly formed ETF, going to go into effect at the end of this month. Facebook and Google are now in there. Some pressure on those names has led that group to the bottom of the list. It's been at the bottom of the list for a few days now. You can see the weakness in technology as well as oil weakness weighing on energy. And then the middle of the road, materials, discretionary, and real estate. Our industry in focus today is one that we've been paying attention to a lot recently. Pharmaceutical services. Over the past 6 months, this subsector has outperformed the S&P 500 by nearly 10%, 9.74%. However, its power bar ratio, which measures future potential, is weak, with more bearish than bullish stocks, and is currently ranked, towards the bottom third of the 21 subsectors that we look at, coming in at number 14, which actually moved up one slot over the past week. I think if you're going to look at names in this group, stock selection and relative performance become really important. You want to look at some of the bigger drug companies, right? We've highlighted Regeneron. We've highlighted names like Pfizer. We've highlighted names like Merck and Lilly here that have all, have constructive charts that have made the turn, that are breaking out. But at the same time, there are still a lot of weak names in there. And some of the indicative stocks within this group that have very bearish ratings that we want to avoid or potentially look for opportunities to go short are Aerie Pharmaceuticals, ticker symbol AERI, Medicines Company, ticker symbol MDCO, and Revance Therapeutics, ticker symbol RVNC. Let's take a look at Revance here now. Very bearish stock. Weak trend, weak industry. We know that this is one we definitely want to avoid. Power gauge rating tells us where we've been over the past 12 months, and you can see this bearish / very bearish power gauge rating since the April timeframe, as well as underperformance really beginning in that time frame and intensifying. So we have a very bearish stock, and the market is in agreement with the model here. The dynamic duo is in gear to the downside, right? Add into that, we are very, very overbought here based on our proprietary overbought, oversold indicator. And Chaikin money flow, for the past month and a half has been extremely bearish. Stock is below a declining long-term trend line. If you are long Revance, I think it makes sense to swap out of that and into a stronger name within the drug industry if you want to maintain your exposure there, or just stronger names in the market in general. If you are inclined to play from the short side, I think the setup in Revance looks compelling. Again, it is a drug company though, so be very aware of what their calendar looks like. Any potential catalyst that can move the stock before making a move within the portfolio. But all else being equal, Revance is the type of name that we want to avoid or potentially look at on the short side. Trending Friday's S&P 500 movers and shakers. Avago, big name in semiconductors, up nearly 8%. Ulta has been very strong of late, and kind of following through on that, up nearly 4%. Expedia is a name that we've highlighted for Chaikin Analytics members as a long idea. Bullish stock up 3.5%. MCK nearly 3.5%, and CBS nearly 3% higher. That stock is in the news as longtime leader Les Moonves stepping down, being pushed out, however you want to call it. I think that CBS is a neutrally rated stock. At this point is a special situation. I mean, at the end of the day, Les Moonves is very, very closely associated with that stock's performance, and his stepping down probably leads me to want to avoid it while things shake out. On the loser side, T. Rowe down nearly 5%, NC down over 4%. We've been bearish on the home builders, and you have Pulte Homes and DHI on the list, as well as TAP, ticker symbol TAP, down nearly 4%. All of these names have neutral ratings, so really no real need to get involved there. T. Rowe has a bearish rating, so potentially want to look at that one if it does eventually set up, if you are long T. Rowe, to get it out of the portfolio. Earnings season is winding down. We did have one surprise on Friday as Genesco, ticker symbol GCO, beat by 8%, and this is in that consumer discretionary group, which has been very strong. So not surprising to see beats come in these strong industries. So as I said, small caps continue to lag. Here is the IWM, the iShares Russell 2000 ETF relative to the S&P 500 ETF, the SPY. And you can see, we were on the right side of this trade since joining Chaikin Analytics in March, when small caps were outperforming large caps. And then back in the July timeframe, we backed off of that call a bit. We said we think the relative trend might be changing. We were starting to see some deterioration in the power bar ratio, and being less aggressive on the relative trend. Relative being important here has been the right call. We continue to underperform, continuing to move sideways. We are above the 200-day moving average, so not a total disaster at this point, but still don't see a real reason to get aggressive with strategically overweighting small caps relative to large at this point. However, from an absolute trend perspective, the trend in the IWM here at the bottom of the screen is still up. You can see it pulled back last week from all-time highs along with the market. But when we look at it on a relative basis, we tend to want to favor large over small in the here and now. The 10-year yield moves higher last week. It's been chopping around in kind of the 2.75 to 2.9% area. We did finally break through 2.9% on Friday. We are above the 50-day moving average, as well as the 200-day moving average, still below that key 3% level. I think positioning and sentiment having a lot to do with that. And what I mean by that is the consensus view on the street is that rates are going higher. I think investors are positioned as such. So it's going to make it hard to move in that direction in the near term until some of that positioning becomes unwound. However, in the intermediate term, it is our view that rates are going to go higher. And a big key to that is this RSI, which refuses to become oversold and speaks to the strength of the trend in rates to want to head higher. I think ultimately we are going to resolve, take out 3%, take out those highs near 3.1. However, I don't think that is going to be a near-term event. I think it's more of an intermediate term event. And as I said, the dollar holding support. Here's the UUP, the Invesco DBUS Dollar Index Bullish Fund. You can see we've been chopping around right around the 50-day moving average, which is still rising. We are still above the 200-day moving average. We've had support in this 25 to 25.20 area. We did hold it and move higher towards the tail end of last week. What we're looking for here is a resumption of the trend higher in the US dollar, and we want to see if that has a positive impact on the relative trend for small caps. I think we're going to take some time, and the reason for that is look at this bearish money flow. Institutional investors are selling dollars. RSI does remain in bullish ranges, so right now, no real concern of a breakdown, but I don't see a breakout in the very near future either. However, we are on watch because of the implications that could have for small caps on a relative basis. So that's it for today. Happy Monday, everybody. Just a reminder that you can get powerful, profitable stock ideas and more. Sign up for Chaikin PowerFeed at chaikinanalytics.com. PowerFeed TV. I hope that everybody has a great Monday and a great start to the week, and a special shout out and thank you to StockCharts.com and StockCharts TV for hosting the show every day in the 9:15 slot. See you back here tomorrow.